There are stocks the banks love, and then there are stocks your retirement can actually afford. This is the breakdown that shows you the difference. Parkway Life REIT pays 3.81%. That is less than the 4.0% you earn completely risk-free in your Central Provident Fund special account. If you are managing money for your retirement, ask yourself a very serious question. Why take on single hospital risk and borrowed money just to earn less than what the government guarantees you? My job is simple, even if the balance sheet is not. I read the numbers that the headline skips, the interest coverage, the gearing, the free cash flow sustainability, so that the Singaporean building or living off a dividend portfolio gets the same forensic clarity that institutional money takes for granted. This breakdown is for the Singaporean at 55 who needs reliable monthly income today, not a multi-year growth story that may or may not arrive on schedule. That forensic promise is not a slogan. It is a method. Every number I run here comes from public filings and verified sources. And when something doesn't stack up, I say so plainly, regardless of what the bank's research team is calling. DBS Research has a strong BY call on Parkway Life REIT with a price target of 4 Singapore dollars and 75 cents, calling it an inflation hedge with a healthcare moat. Their bull case rests on 3 primary drivers: master leases secured with IHH Healthcare until 2042, a projected 20% rental jump driven by a CPI plus 1% escalation clause, and a new revenue sharing model after the Mount Elizabeth Hospital upgrade is complete. But as forensic investors, we have to look at the load-bearing assumptions supporting that entire narrative. The reality is that this entire bull case depends on revenue-sharing rental deals that have not even been signed yet. The analysts need these uncontracted deals to happen exactly as modeled just to rescue the current low yield. Without them, the income thesis completely falls apart at this price. Let's stop looking at the narrative and run this counter through a cold, hard forensic screen. When we look at the core metrics, the dividend yield lands at 3.81%, a hard gate failure against my minimum threshold of 4.7%. Gearing sits at 34.1%, which is highly borderline against my 35% ceiling. Bed utilization is soft at 63%, and while the interest coverage ratio clears the floor at 8.75 times, the stock is heavily overvalued, trading at 4 Singapore dollars and 1 cent against a fair value of just 2 Singapore dollars and 95 cents. To understand these numbers, let's look closer at bed utilization and interest coverage. A 63% bed utilization rate is not the same as retail vacancy in a shopping mall, but it remains a clear caution signal in a healthcare context. The interest coverage ratio of 8.75 times clears my 4 times floor, which sounds comfortable. But with total debt sitting at 903 million Singapore dollars, limited headroom becomes a real concern if interest rates stay elevated or operating income compresses. 3 soft flags push this into zone 4 caution. It is overvalued by 26.4% above the investing pro fair value of 2 Singapore dollars and 95 cents. There is severe single hospital concentration, with 40% of revenue coming from Mount Elizabeth alone. And paper gains are inflating profit. 36 million Singapore dollars of the reported 161 million net profit comes from property revaluations, not real cash flow. Zone 4 caution, the buildings are world-class. The stock is not priced for an income seeker. When we audit the dividend trajectory, we have to look past reported accounting profits and focus entirely on the cash that counts. For the trailing 12 months, the core revenue was 156 million Singapore dollars, and the distribution per unit was 15.29 cents. But if we run a forward stress test simulating a 10% drop in revenue, the distribution per unit falls to 13.76 cents. Consistency of past payments does not guarantee sustainability today. Look at the honest foundation of this portfolio. While the reported net profit sits at 161 million Singapore dollars, 36 million of that is just buildings being reappraised upward on paper. You cannot pay for your groceries or your retirement expenses with paper revaluation gains. The real economic foundation is the 112 million Singapore dollars in free cash flow, and under a 10% cost stress test, that buffer drops rapidly to 101 million. This creates a massive forensic gap between the bank's thesis and the reality of a retirement income seeker. DBS sees a buy driven by a multi-year growth runway and CPI linkages. My screen flags a zone 4 caution due to a below sanctuary yield, a fair value gap, and revaluation distortions. They are pitching growth years down the road, but a retiree needs sustainable retirement income today. This 1 Singapore dollar and 80 cent gap between the bank's target price and the fair value is filled entirely by uncontracted assumptions. You are being asked to pay 4 Singapore dollars and 1 cent today for a 2027 income scenario that currently exists only in an analyst spreadsheet model. As an income investor, you cannot afford to buy into assumptions that haven't been signed. The banks treat the CPI plus 1% clause as a pure tailwind, but inflation cuts both ways. If rising costs are driven by global energy shocks and supply chains, the hospital operator gets squeezed first. Higher utility bills, surging wages. A hospital tenant cannot magically afford to pay higher rent just because a lease clause says they should. Inflation can easily break a tenant's ability to pay long before it ever helps your distribution check. The institutional ownership signal shows that big money is largely looking elsewhere. Over the past 12 months, Parkway Life REIT delivered a total return of just 1.8%. Meanwhile, the Singapore Exchange REIT peer median returned 15.5% over the exact same period. That represents a 13.7% underperformance gap. Institutions are not buying the narrative. The analyst consensus proves that DBS is the absolute outlier here, not the norm. While DBS pushes a $4.75 target, Citi is completely neutral with a target between 3 Singapore dollars and 85 cents and 4 Singapore dollars. More drastically, Nomura holds a target price of just 1 Singapore dollar and 70 cents. DBS is standing completely alone as the exception. When one banking house is significantly more bullish than the rest of the market, and the stock goes sideways while its peers rally, you have to ask yourself what you are actually paying for at 4 Singapore dollars and 1 cent. The broader market isn't pricing in the bank's blue sky model. The market is pricing in flat to modest upside with meaningful downside risk down to fair value. The window closes fast in this market, and by the time public analysis drops, the safest entry windows have often already closed. Before we look at the next structural triggers, if this forensic breakdown is useful to you, the single most useful thing you can do for the channel is hit subscribe. It takes 2 seconds, and it tells the algorithm that data-driven SGX analysis deserves to exist. Free subscribers routinely miss the entry windows identified by forensic screening before the market prices them in. Upgrade to Iggy's Elite Investors for $9 a month to get 0-day alerts, historical lease audits, and real-time trigger tracking. Stop being the exit liquidity and start being the analyst. To see if this REIT can resolve its soft flags, ignore the chatter and watch 3 strict triggers. First, watch the rental restructure execution. Wait for the signed contract on SGXNet, because until then, any distribution per unit increase is just a projection. Second, check the July 2026 earnings release on the 28th of July to see if the interest coverage ratio holds above the 4 times floor. Third, watch for fair value convergence down toward 2 Singapore dollars and 95 cents. Now, you have seen me reference the Investing Pro fair value of 2 Singapore dollars and 95 cents throughout this entire breakdown. That number does not come from guesswork, it comes from this tool. Investing Pro aggregates 4 valuation models and benchmarks them against over 100 factors across the real estate sector. That 295 figure is the average output. It is the same data layer I run on every stock I cover. Full disclosure, this is an affiliate link and I do earn a small commission if you sign up through it. But I was using Investing Pro before any affiliate arrangement existed, and I would recommend it regardless. If you want access to the same forensic data I use, the QR code on screen gets you 55% off. Link is in the description. At the current market price, the yield is compressed down to a meager 3.87%. The only entry price that makes any forensic sense for an income portfolio is a move back toward the fair value baseline of 2 Singapore dollars and 95 cents. A correction to that level naturally pushes the distribution yield up to 5.18%, comfortably clearing our hurdles. And here is the core forensic insight. Entry price is absolutely everything. Your CPF Special Account pays 4.0% with zero market risk. Buying this REIT at a 36% premium to its fair value locks your retirement capital into a yield that cannot meet basic income thresholds before drawdown even begins. Payout sustainability begins with entry price, and if you get the price wrong, a long lease duration cannot save you. Under the Iggy classification framework version 2.7, this stock fails across the board at its current valuation. It is disqualified as a core dividend compounder and categorized as capital growth speculative due to yield failure. It is rated not suitable for accumulation, not suitable for transition because it sits below the CPF sanctuary rate, and entirely not suitable for drawdown portfolios. Let's look at what is real versus what breaks the thesis. The world-class hospital assets, the long-term income visibility to 2042, and the institutional-grade IHH healthcare tenancy are completely real. But at 4 Singapore dollars and 1 cent, the market valuation breaks the retirement income case entirely. The buildings are world-class, but the stock is simply not priced for an income seeker. Buying at this price means accepting 3 heavy layers of risk for less return than a risk-free account. You are taking on market price risk by paying 26.4% above fair value, borderline gearing risk at 34.1%, and execution risk on uncontracted lease renewals. CPF delivers a higher yield without a single one of these risks, and that is precisely why our cautious stance is calibrated exactly where it is. I am Iggy, forensic investor ranked 8th on Tiger Brokers among Singapore retail investors, and your guide through the SGX market jungle. If you want the full breakdown before the free version drops, Iggy's elite investors get 0-day access, link in the description. This content is produced for educational and informational purposes only. I am not a financial advisor. I am a retail investor who applies forensic analysis to my own portfolio and shares that process publicly. Nothing here constitutes a recommendation to buy, sell, or hold any security, and no specific target prices or personalized financial advice are offered. All data is sourced from public filings and verified sources. Where data is unverified, it is explicitly flagged. All investments carry risk, including the potential loss of principal, and past performance is not indicative of future results. If you are making investment decisions involving CPF, SRS, or personal capital, please conduct your own due diligence or consult a mass licensed financial advisor before committing funds.